Good morning, everybody, and thanks for joining us today for the Balanced Perspective. As usual, I'm your host, David Levinson of Net Group Investments, and we're joined on the line by Iain Power, the CIO of Truffle Asset Management. Iain, as always, thanks so much for joining us this morning.
Morning, David, and morning to everyone joining us on the call.
We did take a break in January, so we last caught up with Iain all 2 months ago, so it feels like a lifetime ago. And Iain, I think you were on your way to a lovely beach holiday, and when we were catching up, I think last week over WhatsApp, you told me you were feeling alive, alert, and enthusiastic. So I hope you had a good holiday. I can see you smiling, which tells me you did have a good holiday. So hopefully we have a nice energetic session today, and I think that's probably apt given we're talking about commodities and those which tend to be running quite hot at the moment, and also maybe a little bit on the energy crisis, which we've touched on before, but I think we can maybe scratch again the surface of that topic. So I'm going to start talking about what some of you, I guess, is not so much as evil, but I guess the typical fossil fuel that gets targeted a little bit, which is coal. And I think the energy crisis probably exposed our continued reliance on coal and fossil fuels for that matter. So maybe just a quick recap where we are in terms of energy and specifically coal, because it obviously is very important to South Africa.
Yeah, so David, I think that's right. I think at the moment, the world's addiction or I guess propensity to consume fossil fuels, that demand is fairly sticky, notwithstanding the pivot towards greener, sustainable technologies and energy. And I think the other big factor which has really come to light is that a lot of the sustainable investment in energy, which has been put in the last couple of years, lots of that energy can't be used for baseload production because of the variability of rain to the extent of hydro, or whether it's wind in terms of some of the turbines. And I think a lot of those countries that were relying on some of that energy supply for their baseload were disappointed to the extent that you've now seen climate change really start to affect a lot of these geographies. So, in addition to that, now you've then had the pivot away from, as you say, the dirty fuels, like coal, oil, and I guess a reluctance for companies to spend on new projects, a reluctance for bankers and insurers to fund these projects, which means, we're looking at a scenario here where demand is likely to still climb in the short term and where there's very little supply or capex coming online. And this is pushing prices for energy well up. To the extent that we're coming out of the COVID recovery and we haven't even seen the full recovery of the services and the travel sector and jet fuel, for example. So I think a combination of these factors, probably mean that energy prices are going to continue to be high for longer in the short term until such time as we can get a good understanding of the way we need to produce and consume the energy and the mix of baseload versus peaking capacity. So I think, energy prices look as though they're going to remain high. And I mean, coal, notwithstanding its very, very detrimental impact to the environment, has seen the coal price rocket, back up to levels where many of these Western and Eastern countries are now really trying to incentivize higher coal production to at least give energy in their winter period where, perhaps they need that underlying baseload to the extent that they haven't been able to ameliorate that with greener or sustainable energy.
And I think you wrote in your fourth quarter commentary as well that the Chinese government kind of got, I think it was about 170 mines to expand sort of production on coal, which I think kind of calmed the price a little bit, but didn't really unsettle the trend too much. Before I move on to the next question, maybe just how would a South African investor, I guess, should you view, coal being quite sustained in terms of its price, gain access? Would it be something like, I guess, a Glencore, which recently bought, a bulk or a chunk at least of Anglo's coal assets, as opposed to maybe a pure play? I think there's Exxaro, or, locally, which gives you that option.
Yeah, so I think from an SA context, I mean, the way we've been sort of playing that is largely through Glencore. If you look at the coal assets which are listed separately, and I mean the one which we can look at is largely, which is only coal, which is Thungela, which is a coal business which was spun out of Anglo American. I mean that that share price is probably up 3 times. And if you look at the implied value of Glencore's coal assets, that suggests to us that that's a cheap way to play that. And the balance of Glencore is really focused on many of the green metals, which we're quite positive on over the longer term, given the pivot towards EVs and more sustainable energy supply. So, I think often what you find is the pressures of ESG and the pressure on investors to divest themselves of these assets in their portfolios can create opportunities. And I think the case in point, Thungela, Anglo American really wanted to get rid of that asset. It's not really seen to be core, and to the extent that it is this dirty fossil fuel, they unbundled it, and we've seen now shareholders who were prepared to buy into that at that level, have made 3 times their money. So I think there can be opportunities to be made in many of these energy shares, and I think we would paint Sasol and some of the global oil companies in a similar light, where you're just not seeing the investment in terms of replacing reserves. So supply and demand is going to take over, and there's just not enough supply coming online, and demand is sticky, and that's going to push up prices. So I think investors, if you are selective, there are ways to play this and to identify some mispriced assets.
And you mentioned, I think, electric vehicles or EVs in your first answer there. I think the PGM basket has been spoken about at relative length already in South Africa, and it's obviously been a big driver of performance over the last few years. But I don't want to go into too much depth, but maybe just revisit some of the major sort of fundamentals that are affecting prices of the PGM basket.
Yeah, I think similarly to in the energy space now, you've got a reluctance of the PGM producers to bring on new supply, given their concern about the long-term demand picture. And in the same breath, the pivot, whilst it's happening in terms of EVs, is going to take longer to build out the infrastructure which is needed to support the EVs. And, once again, talking back to grids, to distribution, all the additional power that we're going to need. So I think what that means is there's a window of opportunity for, we think a lot of these PGM companies to continue to supply metal into a market that should remain fairly tight. And basket prices have recovered nicely in the last 6 or 7 weeks. You've seen them move up, compared to the sell-off that we saw in the back end of last year. And I think that's just really talking to the tightness in the market, and that, demand remains fairly robust. And we see, the next couple of years being a good environment for many of these PGM companies to benefit from, these really attractive basket prices.
Mm-hmm. And I think in terms of some of the PGMs, I know you've held Sibanye-Stillwater at least. I'm having a shocking day with my with my elocution today, but Sibanye-Stillwater in the portfolio for some time. I believe they might have just been pulling out of a potential asset purchase in South America, but maybe that goes to talk a little bit of the political aspect of something like, I think it was copper, and specifically more, was it nickel and lithium, which are obviously quite linked to the battery economy as well. So maybe just give us a sense of your kind of more infrastructure type minerals, which would be, I guess, your copper, iron ore, steel, given what China are doing from an infrastructure point of view. But I guess as they're looking to up their own economy and get that growth going again, or at least stabilize it at a certain percentage. But just get a sense of maybe where they mine their politicalness, and also what your outlook is for those commodities, because they're also, I guess, trading at relative highs.
Yeah. So I think generally the commodity company valuations look fairly attractive. They're not as cheap as they were, but they are in a good position to the extent of their balance sheets, and generally the companies are on a very, very strong footing. And I think the one thing that we're seeing this cycle is a real lack of spending when commodity prices are high. So you're seeing a lot of restraint from these commodity companies. And I think, a few of them are starting to sort of, I guess, give us a sense of direction of where the long-term growth is going to come from. And we've seen the likes of BHP Billiton starting to talk about potash and fertilizers and some of those green metals that you've spoken about. And I think we're seeing, potentially a moment where many of the big commodity companies, which have been reliant on the bulk commodity products, iron ore, which feeds into the Chinese steel industry, sort of realize that there is this pivot that is taking place, and there's this need to transition into some of those commodities where there's a much stronger long-term demand outlook. And I mean, you've mentioned nickel, you've mentioned copper, cobalt, magnesium, lots of those commodities would, lithium, which would go into batteries. And I think you've seen lots of the players start to move towards those, but it's a slow incremental move from lots of the commodity producers whilst they try and find decent assets. And I think the problem today is that many of those assets are found in countries which are going through transitions where often there's change in governments, and they more populist nationalist governments are coming into power, and they want a chunk of that revenue. They want some of the spoils for their taxes and for their people. And I think that all of this is inflationary. So I think to the extent that there's not an endless supply of these green metals, you're going to see this pivot towards more sustainable energy, and EVs push inflation into the system to the extent that it's going to cost more to actually mine and get a lot of these commodities out the ground. And we will see a lot of the producers slowly move and try and move their portfolios towards some of these more greener, longer term, structurally positive growth scenario commodities.
Yeah, it's interesting you say that. I was reading a little bit about that Sibanye deal in South America. I think they're saying they might pull out on the back of some sort of seismic activity that was taking place over there. But in terms of where those prices are, they're going to struggle to find an asset at that sort of level of affordability.
No.
Sorry, I don't know if you have any comments on that.
No, I mean, I was just going to say, it's not clear whether they are pulling out of that transaction because of a geological issue, which is the official reason that they've given, or in fact, because maybe they've got line of sight of some of the additional rents that the governments are intending to take from a lot of these sort of projects. So I think just talking to the earlier point is that a lot of these deposits of these green commodities are in countries where the political framework and landscape is very volatile, and where you've got lots of change taking place. And that I think once again talks to the fact that I think it's going to be inflationary, and once again there's going to be a big cost to pivot towards this sustainable energy as well as EVs. And I mean, I'll give you one interesting stat. A lithium battery pack 10 years ago cost you about $1,250 per kilowatt hour. Today it costs 125, so it's down by 90-odd%. And this year was the first year in the last decade where we're actually starting to see battery price inflation. So because of all these cost pressures, the cost of those packs is now starting to rise. And the question is, can we still make them affordable to the extent that we need to move towards EVs vis-a-vis the internal combustion engines? And can governments continue to fund these subsidies that really are required to incentivize consumers to buy these electric vehicles? So I think there's a lot of balls in the air, and I think there's not a unlimited supply of a lot of these commodities, particularly if you look at the likes of lithium. So I think it's going to be, this transition is not going to be without volatility and bumps, and hence, why we still have a healthy weighting of PGMs in the portfolios, because we think, they're still going to benefit from, the current internal combustion engine demand, particularly in the emerging markets, for quite some time.
Yeah, I think you raised some interesting points there, and maybe it's almost worth a session on its own, is how the political nature of a lot of where these mining operations are taking place. I think so much lithium comes from, I think, Bolivia, maybe even Chile, All the mining we've typically chatted about now has been not just in Africa, but Brazil. In terms of where you're gaining your exposure, I guess to copper, which is closely linked also to the communication infrastructure spend as well, or iron ore for that matter. I haven't looked at Kumba for a while. I think that was a sort of pure play on iron ore. It done quite well last year. I'm not too sure the second half of the last quarter. Is it more the diversified space? I mean, you mentioned BHP. I think Anglo America is something you probably hold as well.
Yeah, so we took a position in sort of the end of the third quarter last year in BHP on the back of the very sharp sell-off in iron ore prices, on the back of the slowdown in Chinese steel demand, and which sort of saw iron ore prices fall from circa $220 a ton down to about 80. We saw quite a sharp hit to some of those diversified, or the iron ore diversified producers. We took that opportunity to put some money back into BHP. That's really rallied, it's done nicely for us, up 30-odd%. We've recently exited that. And we prefer the likes of Anglo American and Glencore and African Rainbow Minerals at this juncture, really just because of valuations. Valuations look fairly compelling, and you've got free cash flow yields, double digits, closer to sort of 20% for the likes of a Glencore, with not particularly big capex programs in the pipeline, which means lots of those excess cash flows are likely to come back to shareholders in the form of dividends. So we think the shape of your return from some of those commodity type stocks could look slightly different this year. Maybe you don't get as much capital appreciation, but you're likely to get a 10 to 15% dividend yield from some of those commodity producers, which is a pretty attractive dividend yield.
Thanks, Iain. And I think the last two Balanced Perspective calls, we may have ended 2 minutes early, so hopefully the audience will forgive us for maybe going a couple of minutes over this month. When you were in Cape Town last December, we grabbed a coffee after our chat, and we subsequently started talking about coffee and coffee beans and where harvests are at and how the price is reacting to certain climate conditions. I think coffee is also the second most traded commodity in human history after oil. I don't know if that's on a price or weighting value. I'm not too sure, but I did read that somewhere. But yeah, maybe share some of those interesting comments you had around coffee and how climate was affecting, I think particularly again in South America, which seems to be a theme for today, sort of production and sort of, I guess, harvest and yields there.
No, it's right, David. And I mean, I really like my cup of coffee early in the morning. And interestingly, I mean, for many of you who perhaps don't look at the cost of your coffee, a 60-kilogram bag of Arabica, which is grown in Brazil. So the beans, 60 kg bag of beans, beginning of 2020 would have cost you $100. Today, it's costing you $300. And one of the big things that we're seeing is because of the deforestation in Brazil and the massive loss of forest canopy, it's changing humidity levels as well as precipitation to the extent in terms of frequencies and how much rain that they're getting. And what it's doing is it's resulting in a microclimate where you're now starting to see frost in some of the coffee growing areas in Brazil for the first time ever. And last year was an example where they had such bad frosts, it destroyed, up to 80,000 hectares of coffee plants. So not just the crop, but actually killed the plants. So, the backdrop is a global consumer who is drinking more coffee per capita every year, particularly in the EMs. As we progress and the incomes grow, we're seeing higher coffee demand. And of course, we are destroying forests and destroying microclimates and climates in traditional growing areas, which is now putting pressure on supply and demand. So, if you like your morning cup of coffee, I think we're all going to have to start to get used to paying a little bit more for that cup to get us going first thing in the morning.
Thanks, Iain. It comes with a little bit more guilt. But we are going to put a little plug here for our Responsible Investment Summit on the 8th of February. We have a gentleman from Credit Suisse, and one of their big focus areas is deforestation. I think he alludes a little bit more to the beef industry there, but we haven't even touched on soft commodities in South Africa as well. I think wheat and maize have had decent years. Some of us will be quite aware of what the drought conditions meant for maize, and you find when the white maize, humans start eating the yellow maize, when the white maize is obviously the yields aren't as high as they used to be, but prices also went massively up as we went through some of those climate conditions, I think from 2015 to 2018, but have had decent years since. So very important to say, because food security, and maybe again more topics are coming to mind about what we could potentially chat about in future sessions. But Iain, we have gone a little bit over time. Thank you so much for your time this morning, and we look forward to catching up with you next month.
Thanks, David, and thanks to everyone for joining us this morning on the call.
Sure. Yeah, thanks everybody again for joining us. I was trying to type as Iain was chatting. There was actually almost too much stuff to chat about there. I was very surprised to hear that Tangela was up 300%. I didn't know that. Iain and the team believe that maybe the EV sort of evolution is happening a little bit slower, and energy demand will keep some of those typical fossil fuel linked type commodities relatively elevated. They prefer some of the exposure via the diversified, so your Glencore and your BHP and Anglos. And I didn't mean to put a lot of guilt on your daily coffee, but hopefully the price doesn't affect us too much down here. But I think we will start paying a premium for these type of things as climate starts to have its say on harvest and yields around the world in an increasingly globalized world. But enough from me for today. Thank you so much for joining us, and do take care, and we will catch up with you next month. Thank you.